Hi, good morning. Welcome to the second video on crude volatility. Two things I want to cover this morning. One is just some of the charts that I look at that are non-vol based, and also a potential opportunity that I'm looking at. Okay, so we'll start off with charts. So kind of stay away from all of the intraday stuff, which really is just more noise really when it comes to crude options. So this daily chart, I try and kind of keep it as light as possible, very little on it. This is standard deviations. These are range of the day. I'll cover why the range is important. And there's a couple of trend lines on it. For some reason, I appear to be addicted to this trend line here because we just seem to have spiraled and wrapped around it like a coiled snake. So I feel like I don't want to get rid of it. So we'll just go through some of the charts that I look at. So this is the daily. This is, where are we? So this the three lines at the bottom, four lines at the bottom here, are realized volatility or historical volatility. The actual volatility of the underlying futures contract on the front month. Again, it's the actual futures contract itself rolled, which actually there's one thing I can just very quickly talk about as well, is the roll policy, because I think it's absolutely critical, and it's my number one bugbear when people post up charts. I'll do that next. So what we've got here is this is 256 number of working days, realized volatility of crude, so circa 24%. Now that's representative if the further out you go in the term structure, which I'm just frantically looking. Okay, if I just move over to this chart here, you'll see, as this is what I mean by term structure is the volatility of the at-the-money straddles, or the at-the-money volatility of each month going out for a period of, say, 24, 36 months. That's known as the term structure. So crude's term structure tends to be higher in the front and then will peter back to its average, which, if you looked over here, kind of 24%, realized volatility will usually be 1% or 0.5% under implied volatility. So if this only goes out a year, if this went out 3 years, it would just basically be a flat line. I'll bring a chart up one day and show you that. You can see the peak of volatility here against the trough. The peak is because we have an OPEC meeting. So you always tend to find that that's just becomes an anomaly. You'll also find that, well, this is where I could be proved wrong. This is an OPEC meeting in June. There you go, you see. So July is slightly bit over. The curve would otherwise just run smoothly down to a normalized point. It's why back month volatility contracts don't move as much as the front month. They're less reactive. It's why everyone's trying to trade the VIX futures contracts gets absolutely screwed, because they think it reacts in the same way in which the index does, but they don't realize as it has a term and a structure, it's less reactive. So people wonder why they're not hedged. So the trough here in the G is because of Christmas. So there's nothing there's no spooky science going on here. It's just peaked because of OPEC. Vol will sell off huge after OPEC, and we've got the Christmas trough as well. So anyway, I digress. So here we have the 256, the 50, the 100, and the 20-day. As we scroll back in time, you can see as crude crashed off from the 2014 107 high all the way down to 26. Volatility spikes. The 20 days having massive intra-spikes going on the whole time. But overall, what we ended up doing was lifting the yearly volatility up to 35-40%. And obviously, as crude prices rise slowly, that's just slowly come off. And we're all dancing together now, roughly in the same area, which is here. Down here, 7-day vol. It's quite an interesting pattern that I look at here, as the 7-day realized vol seems to just drop into this level. I have March at 12%. Crude does tend to have a significant move. I don't care about the direction, but it has a significant move after that point, which we can look deeper into that another day. Overlay to candlestick chart. Obviously, in the moment we're kind of dancing around this quad bottom that crude's had, and that. What else do I look at? Hold on. No, not that one. Monthly TPOs, just really to kind of show each of these TPOs is a month, and to look at overall structure, any gaps, any volume peaks or troughs. We'll look at that, and there's also a monthly. Where are we? No, not that one. So what this chart here is, again, monthly charts. The key things I'm highlighting is with these bars is what the current month is and what representative of that has been of previous months. So if it doesn't take kind of much to realise that usually in October, and I'm not talking about contract months, I'm talking about actual calendar months. We have had, you can see here a slight rise in range size for each of these months. Obviously, clearly, in the 2014, 2015 crash, the range sizes were a lot higher. But I'm looking really to kind of, for pricing to people, what's my max exposure and what does a month look like? I know that's not necessarily the representative of the past, but it's really, you tend to find that crude is a little bit quieter in the summer. Crude volatility will represent that by giving you the ability to short sell it and collect some, but you can see it will spike up in October, November. So look at that. Right, I said I'd mention about the roll policy. Right. So there's something to kind of bear in mind is there's a lot of people use back adjusted charts because they don't like to have a gap in their software, which is fundamentally the wrong thing to do with crude. Every chart should be volume based, non-back adjusted, and that can be set up here. So if you're looking at Sierra, I don't know what other people's software platforms have, but basically when a crude volume contract overtakes the other, which is always the day after OPEX. So if crude goes out on a Monday, OPEX goes out on a Monday. On the Tuesday, you'll absolutely notice that by the time the Asian morning's finished, usually it'll be 50 to 60% more volume in the next month. So as November went out, December came in, OPEX went out of November, and by the morning, I think when I sat down at my desk, that the deck was trading at, had done 60,000 and November had done 40. That's when you roll, and you can actually set, if you use Sierra, for it to roll at that basis. You never back adjust. I actually keep a back adjust because I'm just looking really where all the monkeys are what they're staring at. Because if you have enough people looking at that, it will have an impact. So I actually run a back adjusted chart, which it's not representative of where true price was. All the lows are gone. I think if we think about the low that we had it of $26 is now back adjusted. It's been rolled out to like 38. So you're missing highs and lows all the time. So it's just really important to make sure that when you use crude contracts, you don't be afraid of the small gaps. Often they're refilled. People go back and refill them. So if you look, what I do here is the white line here is the month change, so the contract change, and the one without the marker on it is actually the month end. So we've just got a good example here in this 240-minute chart where obviously that's an acceptable gap for the contract roll, but it's filled again usually within 4 bars. There you go, there again. Okay, so that's that. Right. Just something I just wanted to kind of put up is, if we look at this chart here, so this is January crude, which has got a slight peak in Vega anyway, because we've got the OPEC meeting coming. But what you can see here is it's if you look at the chart, this is the futures price. If we look here at this date, so a couple of months ago we were back at this price, 67.78. We're circa there now, and we've come all the way up to the dizzy highs of these are all settles, by the way. That's why you're not seeing the peaks. The dizzy heights of nearly 77. But at the money volatility, as you can see here, is 26% against what it was sitting at 23%. So we're 2% higher, and that's representative of this chart here. So the blue line represents what we are right this second, and each of the prices, rather than showing you a skew by strike, I'm showing you the skew by delta. So that's a 50 delta option all the way up to 10 and 5 delta options. Fundamentally what you can see here is we have a slightly wider gap between these points here, which are the downside concern being representative. The whole skew is slightly tilted to one side. So if you look at it as a cross section of a boat, it certainly looks like it's being hit by a wave from the left side, and it's tilting over somewhat. And more importantly, the most glaring obvious thing is the entire skew is lifted by 2%. So we've gone all the way up, come all the way back down, and if we rationalize time against the two, which I've done with the previous one here, and normalize that, we are 2% higher. And is that, fundamentally we've got equities selling off, we've got the OPEC meeting coming up, and I think I'm not advocating any position, but there certainly could be an opportunity to sell volatility, because this will eventually, as we start to remain in this area, will fade out. And I think even if we did have a continued sell-off in the underlying contracts, you're going to be compensated by this lift on this skew here. So it was just something I'd noticed. I haven't actually seen many participants asking for prices in that space, but that doesn't necessarily tell me that it's not something people should be looking at doing. And you can see here as well, this chart just shows the same thing, with at the money volatility is here in the blue line, and the futures price. As the futures come off, the volatility is just sat bid. That's quite usual of crude. Crude tends to be price rise, vol falls. But when we made new highs, we broke out, the scare factor comes in and the whole curve is lifted. So as we rose from the previous low up to the 76 high, pretty much vol just didn't like it, but tracked higher. We've come off now, which is unusually representative of a normal curve pattern in crude. As price falls, vol does tend to rise. And what will happen is, if we stabilize around here, even if we drop down to 60, and still stabilize, that Vega will have to leak out. So it could be a potential opportunity. It could absolutely be nothing. But right, that's it for today. I will make sure you do your if you do change anything or learn anything today, make sure you have your contract rolls, because it's the thing that drives me absolutely bleeding nuts. And have a good day.